Today, we're talking about diversification. We'll run you through a hypothetical look-back study, which you can find linked in the description below, that our team performed on the benefits of diversification for your long-term investing strategy. By the end of this video, you'll better understand just how diversification can help you in your wealth-building years. Here are 2 takeaways from this video. Number 1, if you pick just one stock to invest in and do not invest in any more stocks from there, you might get better returns than a benchmark return. It could happen, but the odds are against you. Chances are, speaking strictly from the data, that your one stock will underperform the average benchmark return. Number 2, if you add just 4 more stocks into your portfolio, you greatly increase your chances of matching the average benchmark return, and you decrease the chances of loss. The more stocks that you add to your portfolio from there, the higher likelihood of both happening more often. In this video, we'll discuss how this study illustrates these concepts. What is diversification? Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio typically contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets could, on average, produce more stable, long-term returns. When looking at diversification through the lens of the modern portfolio theory, diversification is designed to increase a portfolio's risk-adjusted returns by reducing portfolio risk or volatility for every level of return, or maximizing return for every level of risk. A risk-adjusted return measures an investment's return after taking into account the degree of risk that was taken to achieve that return. Proper diversification is implemented by investing in a sufficiently large number of securities that represent a set of relatively uncorrelated asset classes and geographies. If you take a look at the history of the stock market and look at the performance of each asset class on an annual basis, you'll see that it's pretty rare for the same asset class to perform the best year over year. Lately that it's been the US, but who knows if that'll continue. Diversification is used here as the idea is that the positive performance of one asset class in a portfolio will outweigh or offset the negative performance of another. You're not going to own all winners every year, so you need to spread out your investments across multiple asset classes to offset the worst performers with the better performers. In the long term, a well-diversified portfolio should, although this is definitely not guaranteed, it should increase a portfolio's risk-adjusted return, which takes into account the risk taken to achieve that return. Now let's talk about risk versus returns. For many, investing is about taking on the most risk while also producing the highest returns. That's a goal, right? All investing involves risk, and the stock market, especially since 2020, has been extremely volatile. In times like these, risk is sometimes looked at as the single most important investing factor. The more your investments are concentrated in just a single or few investments, the more risk you might be taking and the less diversified you are. But risk is not necessarily a bad thing, right? Especially if you're young. In fact, for many younger investors, taking on risk could be super valuable when it comes to growing wealth long-term through investing. The concern here is that if you're going to take on more risk, you hope that will come with higher returns as well. And that's the key. You only want to take on enough risk to optimize your long-term returns. Otherwise, it wouldn't be worth taking on the risk. So an easy way to measure the benefits of diversification is to compare a single stock investment to groups of the 500 largest US stocks. And most people refer to this index as the S&P 500 US index. In order to justify an investment in a single stock versus investing in all 500 stocks, for instance, that make up this index, you would want to be certain that your stock investment would have a greater chance or likelihood of outperforming the general S&P 500 index. Otherwise, why would you choose to invest in anything but the index when you can do so really easily through an index fund like an ETF? To illustrate how diversification can reduce portfolio risk or volatility, we conducted an analysis using the returns of the largest 500 stocks based on market capitalization in the US from August 31st, 2011 through August 31st, 2021. After removing stocks that were delisted during the 10-year period due to mergers, acquisitions, bankruptcy, failure to meet exchange financial guidelines, or the price falling below an acceptable level, we were left with 381 stocks for which we had a complete return history. For the purposes of this video, We're going to refer to these 381 stocks left over as the Wealthfront 381. We then looked at what would happen if you invested in a random stock out of that group. Our analysis showed that investing in a random single stock from this group had a large range of outcomes, both good and bad. The stock with the highest return during this time period was NVIDIA, which appreciated to 73 times its original value. However, 16 of the 381 stocks lost more than half their original value. The average return of the Wealthfront 381 stocks during this 10-year period was 362%, which is close to the S&P 500's index total return for the same period. Among these 381 stocks, only 136, or about a 36% chance, beat the average return of 362%. Our look-back analysis also showed how investing in a portfolio with more than one stock provided additional downside protection to diversification. We tested portfolios containing 1, 5, 10, 20, or 50 stocks by randomly drawing from the Wealthfront 381 10,000 times. For example, we randomly selected 5 stocks out of the Wealthfront 381 and performed an equal weighted portfolio. We repeated the draw 10,000 times, forming 10,000 5-stock portfolios. You still following? We applied the same methodology for the portfolios containing 1, 10, 20, and 50. First conclusion, single stock return outcomes have a large range. This one seems a bit obvious, right? Like it's no secret that some stocks do really well, they go up, some stocks go down. You might hit the jackpot on some, or you might lose some or all of your money on others. Like that's part of investing, right? If you get really lucky, you might buy a stock that earns more than 70 times its original value. But the unlucky stocks may also lose most of their money. Let's take a look at one stock, NVIDIA, a company that provides software for the gaming space. This stock grew 73 times during this 10-year time frame. On the other hand, there were 16 other stocks in the Wealthfront 381 that lost more than 50% of their value during the same time period. But what are the chances that you would have chosen this one individual stock over the other 380 stocks as part of this Wealthfront 381? Well, to be exact, 1 out of 381, or 0.26% to be exact. Those aren't great odds. I don't like those odds, and I hope you don't either. You might be thinking, well, what if my choice isn't so random after all, right? What if I do my research and pick a stock that the experts on CNBC or Bloomberg recommend as having the best chance to succeed, right? Those are the experts. Unfortunately, very few investors can actually do this successfully and consistently over the long term. Even if you do all the research in the world and pick the stocks that you think will outperform the others, you're potentially at a disadvantage. You pretty much have the same odds of picking a winner as throwing, well, a dart at a dartboard and picking whichever stock it lands on. There's no proven, long-term, consistent research method that actually gives an investor a better chance of picking the right stock over another. It's really all random. Hence the book, Random Walk Down Wall Street by our CIO, Burt Malkiel. He wrote this book in 1973, and this actually led to the wide acceptance of index funds. In the Wealthfront 381, 136 of the 381 stocks outperformed the overall Wealthfront 381 index. This means just a bit over 1/3 of the stocks in this study did better than if you were to just buy the whole index. Put another way, if you were to just pick one stock over investing in the Wealthfront 381, you would have about a 33% chance of doing better than the index. Again, I don't like those odds. Second conclusion, buying 5 stocks can minimize risk / also minimize your downside. If you buy just one stock, you have a much greater chance of loss compared to owning just 4 more stocks for a total of 5. Even with a portfolio of just 5 randomly chosen stocks, the chance of losing money over 10 years could be significantly reduced compared to owning just a single stock. This one is really interesting to me. Basically, as long as you choose at least 5 different stocks in this randomly chosen population in the Wealthfront 381, versus just one, so you add 4 more stocks, you would have a significantly less likelihood of losing money. You may not get the same returns as if you bought the entire index, but you do have a better chance of just not losing money. Really, adding just 4 more stocks over this time period could have put you in a much better position to grow your portfolio and in the end, grow your wealth. Before we get to the next one, hit that subscribe button and follow along. Third conclusion, adding more stocks further decreased risk. We also found that the more stocks in the Wealthfront 381 that we included in this portfolio test, the less downside risk there was. Put another way, The more stocks you added to your portfolio as part of a diversification strategy, the higher likelihood you'd have matched the return of the broad index and also reduce your downside risk. It may go without saying, but sure, if you choose 5 stocks all in the tech sector and tech takes a massive downturn, for instance, you'll lose even more money. I get that. However, this is a study on the likelihood of an historical outcome. Basically, if you choose at least 5 random stocks, you could have minimized losses and potentially given yourself a higher likelihood of at least matching the returns of the index. We tested this hypothesis using 5, 10, 20, and 50 different stocks. Each time we added more stocks to the portfolio, the chances of matching the index return increased. Okay, so let's get back to this risk factor. This specific study of the Wealthfront 381 showed that the more you diversified your portfolio, the less downside risk, right? That's the best of both worlds. You want to be rewarded for taking on more risk, but if you can reduce risk while also producing better returns, you should take that all day. That's what our study showed diversification at its core can do. Another big takeaway here is that, based on our findings, hand-picking a random basket of stocks on your own that will then outperform the overall market or index is actually pretty hard. All right, so what was the whole point of this study? There's a lot of math that goes into this. We just want to show that investing in the stock market is mostly random. You're likely better off spreading out your investments among many different companies across the global stock market. And that leads us to ETFs. Those that track the overall performance of the broad stock market. These ETFs have proven to be very effective investments to gain broad diversification without needing to pick the individual stocks. You can find an ETF that tracks the entire market, the S&P 500, small cap, mid cap, whatever you want. There are ETFs that cover almost every sector of the stock market. For many young people just starting to learn the stock market, starting with ETF might make more sense. I'm Tony from Wealthfront. Thanks so much for joining. Take care.